Warren Buffett's stock market indicator spiked to a record 170%. What is this Buffett indicator that many news articles online are talking about? One of these articles by Markets Insider mentioned that the Buffett indicator spiked to a record 170%, which underscores the stark divide between sky-high US stock prices and the pandemic-hit economy. And Warren Buffett himself mentioned that the spiking of this indicator is a potential warning signal. To understand why the record reading on this Buffett indicator is a potential warning signal and the potential implications of this record reading, we first need to understand what the Buffett indicator is. In this video, I'll be sharing with you what the Buffett indicator is and my views on what this record reading on this Buffett indicator means for us as investors in the stock market. So what is the Buffett indicator? The Buffett indicator is also known as the market capitalization to GDP ratio. And this market capitalization to GDP ratio measures the total market cap of the stock market against the GDP of the country. So for example, if you are taking a look at the US, the market capitalization to GDP ratio of the US basically measures the total market cap of the US stock market against the GDP of the US economy. So why is the market capitalization to GDP ratio known as the Buffett indicator? This is because back in 2001, Warren Buffett himself mentioned that this indicator, the market cap to GDP ratio, is probably one of the best indicator for valuations. And when one of the world's best investors says that this indicator is probably one of the best out there, people are going to associate the indicator to Warren Buffett himself. And that is why this indicator is also known as the Buffett indicator. Now that we know what the Buffett indicator is and why it is called the Buffett indicator, let's take a look at the formula for the Buffett indicator. The formula for the Buffett indicator or the market cap to GDP ratio is we take the stock market capitalization divided by the GDP and multiply that number by 100. Using the formula, let's calculate the market cap to GDP ratio of the US. To calculate the market cap to GDP ratio of the US, we first need to find the total market capitalization of the US stock market and the GDP of the US economy. The total market capitalization of the US stock market is $35,503 million, and that roughly equates to $35.5 trillion as of 30th of June 2020. And as for the GDP of the US economy, as of the second quarter of 2020, the GDP of the US economy is $19.41 trillion. Okay, so now that we have the total market capitalization of the US stock market and the GDP of the US economy, we can calculate the market cap to GDP ratio of the US. We'll plug in the values and we'll get 182%. And that is a record high number. While there are a couple of ways to manipulate the fraction to have a high reading on the Buffett indicator, let's take a look at the exact reasons why the Buffett indicator has a record high reading. The first thing that we'll take a look at is the total market cap of the US stock market. So the upper part of the fraction over here. This is a chart showing the total market capitalization of US companies. And if you take a look at the latest reading over here, the total market cap of US companies as of 30th of June 2020 is $35.5 trillion. And if you compare it with the end of last year, which is 31st of December 2019, we see that the total market cap of US companies has actually declined from a value of $37.7 trillion to $35.5 trillion. So taking a look back at the formula for the total market cap to GDP ratio, we see that a decline in stock market capitalization of the US stock market will actually lead to a lower reading with all else being equal. But we know that this is not the case because the US economy has definitely taken a hit in the past 6 months. And as a result, the GDP of the US economy is definitely expected to decline substantially. And this is confirmed by Yahoo Finance, which mentions that in Q2, the GDP of the US economy declined at an annualized rate of 32.9%. So even though the total market cap of the US stock market has declined, which with all else being equal would lead to a lower reading on the indicator, but the decline in the GDP of the US economy is much more substantial than the decline in the total market cap of the US stock market. And that is why we are seeing a record high reading on the Buffett indicator and the market cap to GDP ratio. This is a chart showing the market cap to GDP ratio. If we take a look at the chart, right now, as of 30th of July 2020, we stand at 1.71. And at this reading of 1.71, we are at record highs. Because if you take a look at the past few decades as shown on this chart over here, you'll see that on this chart, the market cap to GDP ratio is at the highest it has ever been as of July 2020. And at this reading, we are at a higher level than in the 2000 where there was the dot-com bubble and where the ratio was only 1.405. And with the current reading, we are also higher than in 2007 of 1.059, and that was during the Great Financial Crisis. And this is why some investors are feeling a bit uneasy right now. Because back in the technology bubble in the 2000s and the real estate bubble in 2007, the market cap to GDP ratio wasn't as high then as it is now. And some even think that we might potentially be in a bubble and argue based on the mean reversion theory that sooner rather than later, the market cap to GDP ratio has to revert back to its mean of around 0.8. So right now we are at around 1.7. And to revert back to the mean of 0.8 would mean a substantial decline in the market cap to GDP ratio. There are two main ways that the market cap to GDP ratio can move back closer to its mean. The first way is for stock prices to decline, and the second way is for earnings or GDP to increase moving forward. It can also be a combination of both. Right now, based on the market cap to GDP ratio, the overall US stock market definitely looks a bit overvalued. That said, even though the overall US stock market might look overvalued right now, it does not mean that it cannot remain overvalued for the months and weeks ahead. For example, if you take a look at the market cap to GDP ratio in December 2016, the ratio was 1.23. And that ratio based on historical figures looks overvalued at that point in time. And if we were holding positions in the stock market at that time and chose to sell our positions in the stock market because the market cap to GDP ratio at that time looks overvalued, we would have missed out on the subsequent increase in stock price. This is the price chart for the S&P 500, and based on the earlier example of the market cap to GDP ratio, the market cap to GDP ratio in December 2016 looks overvalued at that point in time. And if we had chose to sell our positions in the stock market at that time, we would have missed out on the subsequent price increase. And that is why I believe even though the market cap to GDP ratio looks overvalued right now, this does not indicate necessarily that stock price will not rise moving forward. And the second point is this: even though the overall US stock market might seem overvalued right now, there are still companies out there which are not overvalued and there are still deals to be found. And a great example illustrating this point is Warren Buffett purchasing Bank of America stocks recently, as recent as a couple of weeks ago. So even though the Buffett indicator might show record high readings, Warren Buffett himself still believes that there are good deals to be found, which he has shown by purchasing Bank of America stocks. This is just my own individual view about the stock market, and is by no means financial advice. If you are thinking about investing in the stock market, make sure you do your own due diligence before even investing in the stock market. If you have learned something from this video, do like this video because it will really help the channel grow and allow me to produce more content such as this. And if you are new to this channel, make sure you subscribe to this channel because you don't want to miss out on these new videos I release each week on investing, trading, and the stock market. I'll see you in those other videos to your financial success.